What's up, guys? Logan here again. Today I'm joined by Maz Spreads, also known as Maserati in the Discord. My man, how have you been doing today?
I'm good, Logan. How you doing?
I'm doing pretty solid. So Maz and I today, I'm going to introduce him a little bit. You guys already know him from the Discord. He's a really great guy, and I'm super happy that he's been able to help with both the free Discord and the premium Discord, and it just really means a lot to us. I know we've gotten a lot of questions from him, so that's what we're going to try to do today is help you guys how to execute spreads on ThinkorSwim, what to look for put credit spreads, and kind of Maz's story and where he is today. So I'm just super excited to have him join us today. So yeah, Maz, if you want to introduce yourself.
Yeah, sounds good. So hey guys, how's it going? I'm really happy to find Logan's community on the Discord. It's been really excellent to get to meet you guys, teach you guys more about what I know so far from the option market. I've only been trading the options market for about 7 months or so. I started out trading the forex market. Usually, like seeing all the ads on Instagram and whatnot, it got me curious. So I looked into forex. And mainly found that one, forex was hard to trade because it was directional. You had to be right. You had to have the direction right in order to make the profit. Two, you also had a lot of broker interference. A lot of times, brokers were manipulating spreads, or brokers were manipulating where the currency was actually moving. It was hard to actually trade a chart, if you know what I mean. When I was like looking at my MT4 platform compared to what was actually happening out on the actual foreign exchange markets, they were completely different. So I ended up actually just before the pandemic came started, and I came back from my senior year of college. Actually, I came back home and started turning on CNBC and started looking at the stock market, and saw that the circuit breakers were flying off on the SPY, and the market was looking really bad. So I knew at some point that the market was going to start to go up. So what I started to do is I just started doing a lot of research in between online classes and all that. And I found that the options were flying off the charts, mainly because people were going huge on YOLOs or stuff like that. But I also started to see that there's other ways that you can use the option market to leverage for a really great financial instrument. And what I really honed in on was credit spreads. And the main thing with credit spreads is that they're high probability, and they have a lot of risk to them, but they usually mean a lot of winners. And I've really found a way that using the ThinkorSwim from TD Ameritrade platform, that I could really leverage all the tools that were shown in front of me to really be able to trade the credit spreads. And what you guys see right now is that I'm not actually in any credit spreads. I've actually been sitting on cash right now for this week and probably next week due to the extreme volatility in the market. You guys see on the left hand side of the screen, you guys will see the VIX here. The VIX here is a fear factor for the Chicago Board of Options, and you'll see that it's currently at 38, which is just extremely high for the VIX. I mean, we're nowhere near 80, which is when COVID-19 was at its highest.
Mm-hmm.
But we're talking right now with the VIX this high, stocks are moving way out of their standard deviation. And that's something that I'm definitely going to touch upon and later in this video.
All right, so I would say my first question would be like, what do you prefer to trade spreads on? I know you were talking about ETFs and just kind of why you choose what you put your spreads on.
Yeah, absolutely. So I kind of just leaned into that question a little bit. I mainly trade these spreads on the ETFs, and why I trade on the ETFs, some people will completely disagree with this, but it's all personal preference, is that I trade credit spreads not for the extreme premium. So when people say the VIX is at 38, that means that the option premiums are very inflated right now due to the extreme amount of value in them. So I don't trade based off of that. I trade off of where I think the stock is not going to go. So when I say that, that's a non-directional method, meaning I can profit if the stock goes up, if the stock goes sideways,
Mm-hmm.
or if the stock goes down. And when I say stock, you can either trade these on stocks or you can trade these on ETFs. And now an ETF, if you don't know what that is, that's an exchange traded fund. That's a basket of stocks. So now in the ETFs, you can have 50 stocks that are winning that day, 50 stocks that are losing that day, and the ETF just goes sideways. Or they could go up or down depending on the percent holding in that ETF. The biggest thing here is diversification and the fact that you're not opening yourself up to single stock risk. So that's what I've been mainly doing with the ETFs. So I'll give you guys some of the main ETFs that I trade, not Datadog. First one being here, IWM. This is going to be the Russell 2000. This is a fantastic stock, or a fantastic ETF. This is really where you guys will see when I talk about ETFs, the biggest thing here, and I'll talk about what you guys are seeing right here on this chart. When you guys see a mark right here, and you see a mark that all the way down like 80%, you can get like $95 because that's what this actually is. When you can see that, you're seeing that there's a lot of liquidity in there based off the bid size and the ask size, as well as value for creating a credit spread. Because when you create a credit spread, which I will go over, you actually need to that's two options that you buy and you sell in a certain order to actually set up that credit spread. So yeah, that's IWM is a fantastic one. TIA, Dow Jones, another really good one. Once it pops up, yep, there you go. So this one you'll see another and some insane value, like all the way down, like 86%. Like you can make some ton of money down here. And I do know that the market's currently closed right now, so these numbers are not up to date. These are just where the market closed on Friday. So these numbers will change, but as you can see right now, calls. This is on the call side. So I mean, there's still a lot of value. When you look at the put side, which is what I mainly trade, you can still see from the marks that you can still make a ton of money down here. So Dow Jones is one. You got SMH. I don't know if you guys have heard of this one. This is the Van Ector's semiconductor ETF. So you're talking about Intel, you're talking about AMD, you're talking about Qualcomm, you're talking about NVIDIA, those kind of stocks. There's a bunch of them, international as well as national. So yeah, you can see again here some fantastic premium all the way up to like 90%. That's exactly what you're looking for. You also got SPY, of course. I mean, this is probably not the SPY. This is probably the most popular ETF out of them all. And as you can imagine, there's some pretty decent premium as well as some extremely great volume. That's one thing to add for the SPY.
Yeah, the volume's nuts on SPY.
Especially
Friday. Jeez.
We're talking like $88 all the way available at the 91.77% probably out of the money mark with a bid ask size right now, not updated, but I mean, just right here is plenty to handle a spread.
Yep.
That's absolutely plenty of volume. So yeah, those are great.
Yeah, I was trading SPY this week.
Also will touch on the Logan, what are you saying?
I was saying I trade SPY mainly when it comes to spreads, and
yeah,
I know you do.
The SPYs are gonna be very easy to trade. You're gonna get in and get out like instantaneously on ThinkorSwim. I can't really speak the Robinhood. It's a little harder to enter spreads on Robinhood.
Yep.
That's why I mainly go ThinkorSwim. Also go ThinkorSwim for a lot of other risk management. But as you can see here, I also trade NASDAQ with ETFs. I go with the QQQ. This is a really good one. 90% probability of the money, $88. That's money in the bank. And then I also can go TQQ. And when we go TQQ, you're going to see some insane spread trades. We're talking like at 88% over $100 available down there, and enough to sell 15. I mean, that's insane. You can easily make. I've traded some TQQ spreads that have been a collateral of like only $7,000 total, and able to pull $1,000 out of the spread. So,
dude, that's nuts.
Absolutely nuts.
What is that like? That's 15%, right around there.
Yeah, you kind of enter the spread. You already have like a 15% credit to a collateral ratio.
Yeah, wow, that's nuts. Yeah, 15%. So like 15% on your money weekly, ridiculous. Of course, not all the time, but
yeah, if you continue to take the basically like the 0.06 deltas, and then trade against that like an 0.3, so put yourself about a decent amount of room. Yeah, it's nuts.
That's awesome.
If you actually look down here, you could even see right now. I mean, the market's pricing in like $233, even at like the 88%.
Jeez.
But those are going to be around like 0.12 deltas. If you guys don't know, deltas are representing a probability of being in the money. So that's about a 12% chance to be in the money. And the probability of the money calculation in this case right here is about 83%. So the deltas and the probability of the money calculation, which I go over shortly, They don't necessarily match up, but it's just another way that you can do that calculation.
Mm-hmm.
So the main ones again, guys, IWM, SPY, TQQQ, QQQQ, DIA, SMH. Those are going to be the main ones that I trade. There's some other ones that I trade, such as XBI, which is going to be a biotech. Now, the biotech was really good when like Gilead and Moderna were skyrocketing off of FDA approval for fast track. But that was way back in March. This is still a good one. As once the data pops up, still a good one to trade. But it also is extremely risky because basically these are like trading. It's kind of, this ETF kind of acts like penny stocks. It's very interesting how it goes once the data pops up.
That is really interesting.
Yeah. Looks like it's going to be slow on me. But again, guys, that's ticker XBI, and that's going to be the iShares Biotech ETF.
Yeah, perfect.
So that's like ETFs, again, not, you trade that way so that you have diversification, because an ETF is an exchange traded fund, meaning there's multiple stocks. Now, if you want to go nuts, you could take a look at Zoom. Zoom is, if I were to trade any singular stock for credit spreads, Zoom is a really great one. See if this pops back. It's just not. ThinkorSwim just not working for me today. There we go.
It's all good.
Yeah. So with Zoom, I mean, we're talking 94% chance to win. You can make $115. Now, what you got to ask yourself is like, one, I mean, if Zoom's currently priced at 460, I mean, do you truly think Zoom could fall all the way down to 355? Now that difference is just about $95. Zoom has fallen, I've seen in days where it's fallen $46 in a single day.
Yeah.
So while this looks like there's a lot of runway, I mean, it's possible that Zoom could be taken out that fast. I could also see right now, if you guys ever notice these numbers when you look in the option chain, these are going to be your expected moves. Now, this number is going to have a 68% probability of being accurate. It's saying it's a plus or minus 44, which is going to put you down around the 420 mark. So that's another thing to take worry of. This number, it could either stay within that range or it could even go farther out. And I'll show you guys how you can use that number to your advantage. So yeah, Zoom's a great one. Google, of course, is a great one. If you got money to do it, Amazon is a great one. I really like Nvidia. Nvidia was making money for me when I first started, because I started trading stocks first and then realized ETFs was the safer bet. So Nvidia is great. I also was trading AMD at one point. That was a really safe stock. Disney is a nice one.
Yeah, Disney.
Disney was great. Bank of America was actually making about $46 per spread for me on average. So yeah, those are some great singular stock opportunities. But again, you're gonna have to want to ask yourself, is that risk something that you want to take on? Because if you start to go in the money on one of these singular stocks on the spread, you're gonna be hurting. So like I said, stick to ETFs. They make less, but you're going to have a lot more winners, and you're still going to see that compounding growth in your account, which is what we're all after.
Yep, that compounding growth on it too. And I know you've been really successful with your account size and how much you've grown it over the last 7 months.
Yeah. I've seen when the SPY was like way down there. That's when my account really started to pop off right after that V-shaped recovery. I've essentially taken about $5,000, and we're looking now around 58,000. Wow. So that's been really just phenomenal.
That is like an 11 times return on your. I mean,
that's awesome. What it really equates to is it's anywhere from about 10% to 12% of the account value in growth. Week after week after week. I am trading. If you guys don't notice, I am trading weekly credit spreads, and a lot of people will say, "Oh, well, you get more value if you trade 30 months out or whatnot." In reality, I just do enough calculations where I have a really great method to know where I think a stock is going to go in a week's time.
Mm-hmm.
But that method, the probabilities then when you start to go way out, they become skewed, and they
Yep.
become skewed based off where the VIX is currently at. So if the VIX right now, with that being at a 38, what is a 90% probability of money on a weekly is like only a 60% chance probability for the end of a month. So you have
Wow.
a huge probability skew, and that's why I'm mainly trading weeklies. Yes, I know I don't earn as much for each spread, and I do put up a decent amount of collateral to earn them,
Mm-hmm.
but that's the idea, is that I can continue to get in these and get out of these. The other important thing, and I'll show you guys when I execute, I do put credit spreads Monday through Friday,
Mm-hmm.
and call credit spreads Thursday through Friday.
Mm-hmm.
And when you take the call credit spreads, that's mainly because you could see how much the stock has moved, and I can calculate where the ceiling's at. And I know, hey, if I have a $6 room to the ceiling, and this stock and this number here changes throughout the week, if that number is only a plus or minus two,
Mm-hmm.
taking a call credit spread at the $6 to go ceiling is a really safe money in the bet. And then also, whenever you do a put credit spread, the collateral for the put credit spread is good for the call credit spreads.
Mm-hmm.
So there's no buying power extra when you add the call credit spreads. So any option trader would know that I essentially create an iron condor over the duration of the week, and the iron condor does not become skewed. Usually, when people take iron condors on Monday, they're opening themselves up to having no clue where the stock is going to go.
Right.
When I just take a put credit spread, I create that credit, and then I create an opportunity where if I take the call credits and they were too tight, I can exit for a small loss, but still take money out of the position.
Mm-hmm.
So I could still get 8% return on the account and about an 88% return on the entire position total. So it just opens up a lot of flexibility for me, and it's been working out extremely well.
And that's one thing that I really like about the way you play it too. And that's where I think we have a lot of hope for a lot of the members, who are following any of your plays, or just even for yourself or myself, right? Is you pick 5 ETFs for the week, sometimes 6, right? That you trade on, and you're shooting for 10%. So maybe if you do get stopped out of one position, like maybe that week TQQQ got really close, and you get stopped out of it, or close it early, you still are diversified well enough to where the rest of your positions could still expire at 100%.
Oh, absolutely. Yeah, that's a great thing. The other thing I usually do, if I have a feeling that the VIX might pop during the week,
Mm-hmm.
I don't necessarily use all the collateral in the account,
Mm-hmm.
or all the buying power in the account. Basically, I refer to as the buying power
Yep.
for the spreads. I'll leave 20% on the table. That way, I can get out of a call credit spread like almost immediately,
Mm-hmm.
or out of a put credit spread almost immediately at a debit, and still be able to not see the account blow up. Because a lot of people trade these spreads and are like, oh, Amazon's not going to fall $100 in a week. It falls $100 in the week. They put up a $10,000 collateral, their account is gone.
Yes.
So that's the thing. You want to open yourself up to being able to know what you're going to want to do, whatever the market gives you, because
Yep.
the market's neutral. You got to know that you have to trade what the market shows you. So in my case, I usually like to trade. I start below the market as my anchor, and then every day I'm monitoring, I'm tracking, I'm just doing simple calculations of where the stock has gone, how much the stock has risen,
Mm-hmm.
and what percent of expected move is still available to the stock. If the stock has only 10% move still, I'm not going to do a call credit spread on that, because that's opening up too much risk.
Right.
So there's a lot of, I kind of call it a playbook. I typed out a playbook for myself. I know what I'm doing, whatever the market shows me. And if there's something new that the market shows me and I don't know what to necessarily do and I have to think about it, I just add that right to the playbook, right to the journal,
Yep.
and just get ready for next week.
Oh, that's perfect. That's a great way to do it. And I mean, you did the right thing this week. I know like a lot of people got clapped in their positions, and it's just how it goes when the VIX gets really high too, and you see a lot of, like me specifically, I have been trading options for about as long as you have, right when the market started crashing, but I never really did spreads, and I've had a lot of questions about them. And that's one thing that with me following you that I've learned a lot about is like when it's a good time to start to monitor your position even closer, because you start to get into, like, I call it the danger zone or no man's land. I like to call it no man's land, to where you're like, oh shoot, if this ETF that I'm in drops $3 more, it's gonna start digging into my collateral, and is that worth the risk to make an extra $20 this week if I do let it expire?
Right.
Like that's the one thing following you that I've opened my mind up that way.
Exactly. Yep. Yeah, there's ways to go about getting out of an entire position still profitable. There's ways to set up alerts to,
Mm-hmm.
if you're delta, I usually trade around a point 10 or a point 12 delta. If that delta starts to rise to a point 20 or a point 25, I know that my spreads are losing value,
Mm-hmm.
or actually, sorry, they're gaining value. So that means that the position is losing. So then I could just cap that loss real quick,
Mm-hmm.
and so be it. I mean, so be it. If the stock ends up closing below the short strike on the spread, meaning the spreads actually would have made money by the end of the week,
Mm-hmm.
I'm okay with that because I still have other positions that I'm in that can gain me back that money. Like I said, if I don't, if I always shoot for a 10% account growth total at the end of the week.
Mm-hmm.
If I don't hit that, that's okay because I still gained on the account. I didn't blow up the account. I didn't give back any collateral money, and I did not see the yellow ITM, which I fear when I
Yeah.
trade these spreads. I haven't seen that since I started. So that's what we want to avoid. The in the money usually happens when your deltas get about. I usually see them come up around 70. So if your delta gets to 0.70, you're about to go in the money because now you're at a 70% chance of being in the money. And especially if that happens during the middle of the week, then you're in trouble. Just get out of that position, clear your mind, get ready for next week because you can
Mm-hmm.
get it right back.
Yeah, that's how I've thought about it too. Because I took a stop loss on SPY this week because I was almost in the money when SPY opened on Wednesday, and I had it to expire on Wednesday, but we dropped like 7 points overnight, and a position that had I think it was 87% chance of winning was almost in the money. So I got stopped out and was like, oh, so this is like the bad side of it.
Yeah, the worst part about spread trading is the fact that the futures are going to dictate what happens to the ETFs in the after hours. If
Mm-hmm.
you see a massive gain in the futures, then you know that all right, boom, you're going to gain a lot of profit on the position at open. If
Mm-hmm.
you see a massive drop, then you're going to be like, all right, let me open up, let me turn on CNBC, let me see what all the guys are saying about where the expected open is
Yep.
for the ETFs, and they show that on the every 15 minutes they show where the expected open is for the ETFs. Or you could also just pull up a chart and you could, in after hours, if you have it turned on, you could see where the ETF is currently trading at. So yeah, if your spread ever would go in the money after hours, that's just it's a call on yourself. Basically, what would happen if you ever happen is essentially you would have a trade that had an 87% chance to win,
Mm-hmm.
and then if it goes in the money after hours, then we're talking as it's like a 6% chance to win.
Wow.
So you could still hold it out if you wanted. If time is always it's in your favor if it's in the middle of the week.
Mm-hmm.
But like I said, if it continues to keep going down, eventually you're gonna see that all the collateral money was taken off the account and whatnot. So I usually always, as soon as it says in the money, I'll close and I'll just work. I'll rely on my other positions. If I start to see my other positions start to close, I might just get out that entire week, still be able to get out at a capital gain or a small loss on the account and just move on.
Which is perfect for your risk management. And I know that's a lot of the questions I've been getting too. So it's just really great too. And the next thing I wanted to ask you too is if you could show us how to execute a put credit spread.
Yeah.
I think that'd be awesome. And then we'll keep
Yeah. So
talking about it too right after you show us how to execute it. But I'm pumped, man. We're learning a lot right now.
yeah, absolutely. So we'll start with the spies. That's just really, if for beginners, this is going to be the easiest one to get in, to get out. Yeah. So when you do a put credit spread, we're on ThinkorSwim here.
Mm-hmm.
If you guys are using other platforms, plenty of other videos as to go over it. But we also in the Discord we talk about how to execute these spreads on any platform, whether that be Webull, Robinhood.
Mm-hmm.
Some people are even trading on Tastyworks, which is also a really great platform for
Oh yeah,
spreads.
safety works.
Yeah, that's a really good one. So yeah, we'll just start. I'll just do a generic one. Doesn't matter, not necessarily one I would take. This is not a recommendation or anything like that. So when you start a spread, basically it's all about a right click. The biggest thing here is you want to choose. You want to think like you're like the bank. You're giving out, like, when you get the collateral, that's like a loan. So you're
Mm-hmm.
giving out that money, and you're going to get a small percent back, but it's a high probability chance. So if you were to just to take, let's just look at the deltas here real quick. You want to take like a 12 delta trade or 12 delta trade. So you're thinking, right, what you think of yourself right now is that the SPY is not going to hit 300
Mm-hmm.
by the end of next week, or November 6th, Friday,
Mm-hmm.
November 6th. And that right now, the SPY being around 327, 326, I mean, you're giving yourself about $27 runway, I like to call it.
Yep.
So that's pretty solid. So if you think that, and you like the probabilities in your favor around 86%, which I will take any day of the week, that's really good. So basically all you do is you just right click, and you're going to go to sell, and you go to vertical. It's that easy. So when you see right here, you're going to see my default, usually trading about 10 contracts or so to start out.
Mm-hmm.
What you're going to see here, you're going to see a minus 10. That is, you're selling 10 contracts. You're selling 10 contracts at the 300 strike price. So you're selling those contracts. That is getting you 1.5. That's your mark right here.
Mm-hmm.
So that's getting you about $150. Then you have to, when you do the spreads, you sell the lower strike, you sell the higher strike, and then you buy back the lower strike.
Mm-hmm.
So we're buying a 295. Now the thing when you do spread trading is that you are only able to do what the market prices in, or the CBOE prices in. So the CBOE is noticing that anybody who's trading after 300, there's not a lot of liquidity out there. In terms of people on their data. So they're saying there's no one actually looking to trade at 298.
Yeah.
So they made it $5 increments, which is fine. So basically what this is saying is the difference between the 300 and the 295. There's a $5 difference between those. And what that's going to be is that's going to be the start of your collateral. So right there is about, this is going to be, right now you're talking about a $500 collateral.
Yep.
But we're also talking 10 contracts. So you multiply that 500 by 10. We're talking this trade. You need about $5,000 enter, and then you subtract about $350 from that to your initial credit.
Yep.
But you're buying that put. Now, what that put is if you were just to sell the 300, yes, you collect a lot more money. But buying this put is giving you insurance. From the fact that your risk is no longer unlimited, your risk is now capped. Your risk is going to be capped if the SPY were to fall to 294. You're at a max loss on the spread. You're in the money. It's not good, but you're not subjecting yourself to an unlimited loss. Your loss would only be about 5,000. I think it's like $650. That'd be your loss. Big loss, but again, it's not going to be dreadful if you were just selling a naked put. So that's what these spreads are doing. A lot of people look at option, talk about the wheel strategy. Well, if you do the wheel strategy, that's just selling naked options. In this case, we're selling a credit spread, which is just giving you the added insurance of knowing that your loss is not unlimited now. So we're selling the 300. We're buying a 295. This is considered a vertical in ThinkorSwim. We're looking at SPY. We're looking at next week. That's what November 6th is. Now, what this is saying it's 35 cents per spread. Then basically about 35. It says 35 cents. Then you multiply it by the 100 multiplier in option trading. So that's now going to be about $35 per spread. And we're getting 10 of them. So that's about 300. We're collecting $350 per spread and putting up about $5,650. So if you like everything here, the nice thing about ThinkorSwim too, you can do a limit order or you can do a market order. If you do a market order, it's going to be instantaneous execution. So if you just want to get in and pay a little bit more in buying power for that market, for any slippage or anything like that, go for it. Usually what happens for a market order, if you see down here, if you do a 35 cent, we're talking about the mid price, but the natural price is 30. So a market order is going to be you're going to get about $32 credit.
Okay.
If you want to get in like right now. Sometimes I do market orders if I see the bid and the ask size. If there's a big difference between them. Now, what I mean, when bid and ask size on Robinhood and ThinkorSwim are two different things. The biggest thing here, the bid size here is saying that there's 25 contracts and the ask size is 280. So if there was a 0 or anything there, or like a 1 in this case, there is a 1 right now. Obviously, this market's closed. I might want to do a market order, and that means that it might actually jump down to a 290, and I just get a little less, but it takes the contracts off that 290, and I'll still be able to get in. So it's just another algorithm for ThinkorSwim to use. Just means that you're going to get less credit than you want, but you're in the position and you don't have to wait for the limit to fill, unlike Robinhood. So $35, $350 on the spread. Again, you can change your limit to market if you want. Keep it to day. Usually I put these on day because I usually just enter them only on Mondays or Thursdays, depending on what the market's doing. Again, Mondays put credit spreads, Thursdays call credit spreads. Instructions none, exchange best. You just hit confirm and send, and this is going to pop up the order panel. So again, this is going to say that your break even. This is when your spread will start losing money. Like I said, we're looking at the 300. So as soon as the SPY were to hit 299.65, which is 300 minus 35 cents. So once it hit that value, that's when your position is going to have a profit loss of 0. As soon as the SPY were to go like 299.30, you're going to be at a loss.
Okay.
And that loss will start to accelerate and whatnot.
As it continues to fall.
That's right. As the SPY were to continue to fall going down. So the max profit is 350. The math came out to 4,650 as your max loss. Your cost and commissions, your actual credit, what you're actually going to get is around $336. So what that is we're trading 10 contracts. This 33 cents is a fee from the actual Chicago Board of Options, and then ThinkorSwim charges 65 cents per contract leg. Honestly, guys, I want a platform like this, just because it gives me a lot more access to a lot more data, gives me a lot more education. I'm fine with paying 65 cents. It doesn't affect my portfolio. It shouldn't scare anybody away either.
I agree. That's one thing that a lot of people have been talking to me about. They're like, oh, I heard there's commissions though on TD and Robinhood's free. And I'm like, well, generally you fill at a better price. So when you pay the commission at the end of the day, just kind of think about it like this was to save you the money that Robinhood would have, charged you to fill at a different price. Like I even think about it that way too. So.
Yep, exactly. Robinhood, if you guys don't know, that's just a venture capital behemoth. They're huge. They just sell your order flow, really.
Yep.
If you want to talk about market, they create market makers. I'll just put that. That's literally how I see Robinhood. Everyone's making money on Robinhood, which is fantastic, and I'm happy for you guys who pull off the YOLOs. I can't pull off a YOLO for my life, but I can pull off these credit spreads, and that's just because I think differently and whatnot. That's just a really different way to go about it. So I'm willing to put up that. I'm willing to lose $13.33. They get a good fill and to have a good solid risk management and to know that I can get out of a trade and not struggle to be filled. So I'm willing to put that. I'm willing to get out of that. And then you're going to see these other things. These are account specific. Right now, my buying power is low, and the buying power for the stock and whatnot. Buying power is low because the positions are still on it, which is fine. I'm also in an Apple leap, and that's down, so that's probably contributing to it. No worries there. So you guys, if I was going to do this, I would just hit send, and it would go to my working order tab. It would be rejected though. But that's how you enter. The biggest thing, again, you go up to the strike price you want. It doesn't matter where you click. Just right click, sell, vertical, right there.
Yep.
That is how you enter a credit spread, a put credit spread in this case, because we are trading on the puts. So yeah, that's the execution.
Perfect, perfect. Yeah, and that's gonna help a lot of people out. I know it's gonna help even me out with ThinkorSwim as well, using it to execute them. I've been using Robinhood a little bit and having a little issues sometimes filling orders, like you said. So
Yep.
it's just nice to
Yeah.
know that you'll be
You'll
able to do
find
it.
that a lot of times when I exit, I want to have a market exit. I want to
Hmm.
get out right away.
Yep.
Boom. Don't want to have any more losses if I ever need to do it. That's why I'll pay ThinkorSwim. I'll give up a little bit of cash on the commission side to know that I can get out of position right away to not destroy my account.
Yeah, perfect.
The
And
other
then,
nice thing about ThinkorSwim, if
yep.
you're a trade on the platform, is that if something were to go really wrong, like if there was a massive, just a huge red candle out of freaking nowhere,
Hmm.
their risk management team is working during the market hours. Like they're like working 24/5. So they can get you, they can automatically exit you out of a position, usually for more than the max loss. But I mean, that's the difference between still having an account the next day and
Right.
whatnot. So I've had that happen one time. I actually had them to take me out of position because I could not get the market order would not fill
Hmm.
because the volatility was so high and there
Wow.
was just not enough liquidity where I was at. So they ended up taking me out and whatnot. And I learned from that. I wrote down some notes on that in my journal, and I was just happy that they were there. They saved my entire account. This is when I was first starting out. This probably happened in April.
Yeah, right off the bat when
Yeah,
everything got shaky again.
exactly. When
Yep.
they're after the first V, there's that first leg down.
Yep, that leg
People were
down.
going into hysterics, and the account took a little hit. But we recovered, and obviously we figured out we've learned from our losses. The big thing of credit spreads, you learn from your losses, and you just get ready for the next week. Just keep going.
Definitely. That's awesome. The other question that I had too is how to edit your option train.
Yeah, that's a great question. So a lot of times when people pull up the trade tab right up here on ThinkorSwim, you're not going to see what I currently have. The first thing you want to make sure you do when you're trading put credit spreads right here for strikes, a lot of people are going to see like a 4 or a 6. It's going to
Hmm.
look something like, let me scroll back up. It's going to look something like this. Yeah, this is not good because this is showing you at the money. You shouldn't be trading spreads at the money because you're going to have like a 50% chance to win. Yeah, if you want to roll the dice, go for it. I can tell you the SPY is going to go down, yeah, a little bit at the open on Monday because that's usually what happens.
Yep.
So it's very simple, guys. Go change whatever number you currently have. Just change it to all. It's going to make your life a whole lot easier. We're
Yeah.
talking now SPY 220. I mean, there's no size available, but I mean, you're going to be able to see your whole option chain. And you just scroll up or down and you can see it. And again, November 6th, because the SPYs do have Wednesday expiration. So just make sure you trade on the Friday. You're
Hmm.
going to gain more than the Wednesday.
Correct.
So that's the first thing, strikes to all. The next thing up here, option chain filter off. If you guys have some custom filter that works for you, go for it. Spread. A lot of people say, "Oh, change your spread the vertical." Well, if you do that, you can't. It locks you in usually at a $5 interval.
Hmm.
So just change it to single so that you can see all your options.
You
The
can
next
select
thing, the
it.
biggest thing here is your layout. Now, a lot of times people are just they're gonna have last X, net change, or delta gamma, theta vega, whatever your default is. Just go down here to customize. Biggest things here for my setup. I have bid size. Bid size is saying how many are able to be sold. Ask how many can be bought, how many contracts that is can be bought. Your delta is saying if this were to get in the money and the stock underlying goes up $1,
Hmm.
how much will the option increase? Another way to think about it, probability of in the money calculation. If your delta is zero point 0.2, that means there's a 20% chance of it being in the money. If your delta rises to 0.8, there's an 80% chance that you're in the money. Probability out of the money. Now, this is a calculation that is available on ThinkorSwim. It is available on Robinhood. It's a derivative of the Black-Scholes option pricing model. So it essentially takes in a whole bunch of calculations that it does, and it basically spits a number out for you. It does about 100 lines of mathematical code for you guys, which is a really great feature on this platform. So that's going to be that's a must. Probability out of the money. If you're trading credit spreads, this is a must. You must have this on your option chain. Mark. Now, Mark, obviously you guys know that there's a bid quote and an ask quote. The mark is just going to give you the midpoint of those two quotes and an average price of where that spread or where that strike leg will be filled. So right now, if you look at the 301, it's saying that the mark is about 1.605. So then I know, all right, if I do a 301 and then a 300, the 300's at 1.505, that means I'm going to be able to get filled for that spread on average around 1.105. So it's just simple calculations in your head that you can do, but the mark is really good. And mark also can clean, if you don't necessarily need this then if you're trading off the mark, but I still have it on there.
Yeah. Yep. I use the mark too.
Yep. And then I have percent change and net change. These are again, these not necessarily used for credit spreads, but it's interesting to see. Ideally, when you trade spreads, you want to see negative. Like you want to see like a negative. I don't even know. Like a negative 14 or a negative 20, because you're trading and you want the spread to be worthless. So if you're trading a spread and it's worth $35 a spread on Monday, you want it to be worth like $2 on Friday, and then you could just hold that out and you could expire and then you get all $35 per spread. And that's so I just look for percent change and make sure that it's falling. If I start to see that it's like a +6 on the short strike, that usually means that my deltas are moving into the money.
Okay.
Closer to in the money.
Oh, that's awesome.
So yeah, just look for a percent change and make sure that the options that you've chosen are going down and not up in green. And net change is kind of a default just to see how much those options have fallen over the course of the day, and I track that, and that's something I again track and I make sure I report. So net change is that. But yeah, if you guys don't know how to adjust your layout, you just click something and then you just hit add item and that just moves it over there. So these are the 7 things you guys want to add to your set or your information layout.
Perfect.
And then when you do that, should look something like mine. The most annoying thing about ThinkorSwim is that not everything is a perfect mirror. So if you put your bid ask here, it's not going to be like over here on this side. So you just have to get used to it and whatnot.
Yeah, that's really cool. And I know you're talking about advising, the put credit spreads and how to execute them. Just showed how to edit your option train. And the other thing that I've been getting asked a lot about is like, what's the ideal put credit spread setup?
Yeah, that's a good one. So yeah, the ideal put credit spread setup. Now, a lot of people will say, oh, well, you usually want to enter on a technical basis. You want to enter on a fundamental basis. I honestly enter just based off of probabilities alone. I think about, all right, if this is pricing in the fact that there's a 92% chance to win, I will just get it. I will just get in and take it. Now, one thing that I do usually look at, if you do look at charts, I don't necessarily look for a technical factor, but what I look for is the range of the chart. Let me open this up to a single chart here, and it probably will pull up a SPY, exactly what I was looking for. So right in here, you have a 1 day, 1 minute chart. The SPY, if anyone's watching this right now on November 1st, in after hours, the SPY is around 327. So the first thing I'll do is I will look up, not settings. I'll pull up I'll pull up, actually, I don't have it set up. I have it set up on my phone because ThinkorSwim, the mobile application is just phenomenal.
Yep, I like the mobile app for ThinkorSwim. It really helps.
Yeah. Actually, you know what? I could do it right here.
Sure.
It's do a 3-year weekly chart, and then usually zoom in a little bit. The biggest thing here is whenever you put your cursor on a candle, you're gonna see. It's gonna move for me. If you guys see, you'll see the O, H, L, and C. The O is gonna be your open. H is gonna be your high. L is gonna be your low, and C is gonna be your close. And R is your range. So every week before I go into the next week. So right now, this is the week of the candle ending on the 26th of October, which was this past Friday. Um, so tomorrow, or actually, yeah, tomorrow morning, or potentially tonight, if I get around to it. What I do is I pull up all my ETFs I want to trade, I want to look at, and I write down what the difference was of the open and the close. And I also write down the range. Now, the range is going to be the entire distance that the candle traveled. Your open is obviously going to be where the candle started, and then your close is going to be here. As you can see, the SPY dropped pretty good this week. What I like to do is I like to think that if I know that the bracket of that the SPY was trading in this case, had a total distance of 20.38, I think then that, all right, next week for the put credit spread, I want to position myself about $20 a strike difference lower than where the SPY is currently at. So now I'm thinking, all right, on average, because you don't just do this blindly. Then I look at there's some other calculations that I'll show you. Right now, I'm thinking, okay, I want to position myself to potentially start my put credit spread the short leg of my put credit spread. I want to look now potentially around the $300 level. So this is where I could potentially put myself.
Okay.
Because what you want to do down there is, obviously we don't know what's going to happen next week. No one knows what's going to happen next week. But I'm putting myself at a percent probability that I am outside of a 1 standard deviation move of the stock. Now, when I say a 1 standard deviation move, that is usually, if you guys ever know what a bell curve is in probability and statistics, and this is something that I could do in another entire video just on itself.
That'd be great.
The bell curve is relevant to the stock market. And a lot of times what you see the bell curve is honestly, if you put this volume, if you turn that up on its side and put it and changed it instead of time basis to a price basis, it creates a bell curve. And that's going to be called your volume profile in the market. Now, that's not something that I usually trade off of, but it's something that if you look at the volume profile, and if you guys don't know what the volume profile is, you guys, not settings, sorry. If you guys go to your studies tab, you can just type in volume profile. Yeah, right here. And then you can add that to your chart. And there's some settings that again, a whole separate video on that. But that's just the whole idea here, is that it creates a bell curve. And the biggest thing is when I say yes, a 1 standard deviation move. Standard deviations are very important in the stock market. A lot of people will say, oh, well, just use Fibonacci. Well, Fibonacci actually can show you where those deviations are, but those standard deviations differ on how you draw the Fibonacci tool. So I don't usually go to Fibonacci. I usually just do the calculations myself. So I'm thinking right now, I want to be outside of a 1 standard deviation move to the downside on the SPY, because I'm doing a put credit spread. So a put credit spread is always below where the instrument is currently trading at. So I'm looking right now around 300. I want to give the SPY next week, even though I'm not going to trade next week due to the election. This is just a hypothetical.
Yep.
I am talking that I think the SPY could potentially move about $26 next week to the downside.
Okay.
And I want to position myself outside of that 1 standard deviation move. So a 1 standard deviation move, I'm thinking, is probably around $18 on the SPY. And I'll show you guys where you guys can go to exactly get that number. But I'm just making sure that when this price opens on Monday, right now, there's 2 numbers that I'm going to check. The first number I'm going to check is this 20.38. That's going to be your range. That's the total distance of the candle for last week. The next number to check on Monday morning, as soon as the market opens, you want to check this number right here. This is your, yes, it says implied volatility.
Mm-hmm.
Implied volatility of 50.11%. Now, if you multiply the opening price on Monday, which is probably not going to be 326.54, it might be a little higher, it might be a little lower.
Mm-hmm.
We'll just use 326.50 for example. If you multiplied 326.50 by 50.11%, then times that by the square root of the days until expiration, which is 5, divided by 360, you'll get 16.543. And because you use the square root, you get a plus or minus 16.543. Mm-hmm. This is saying that it believes that the calculation on the platform believes that the SPY will move potentially 16.5 points to the upside or 16.5 points to the downside. This is also saying that this number is calculated with a 68% chance of accuracy. Mm-hmm. So there is a 68% chance that the SPY will stay within the plus or minus 16.5 range. And then there's that 34% chance that it won't. It will move outside of that.
Outside that range.
Yeah.
To the up or down side.
So this number is establishing this number is establishing a half standard deviation move of the SPY.
Okay.
Now, a 1 standard deviation move of the SPY is going to be around 86% probability out of the money. Mm-hmm. So that is saying that the 1 standard deviation move of the SPY is approximately going to be about 26.50. Now, that number, again, I expect this plus or minus 16 is going to change to about 20. Mm-hmm. So again, you want to make sure you do this during live market conditions. If I use the on-demand tool, I mean, the computer would probably break at this point. Zoom taxes it so much. If you want to just check the probability out of the money is around 86. When you do that, you're establishing your one standard deviation zone. If you bump up 86 to 90, which is going to be right here, mm-hmm. you could see that the 1 standard deviation is at 301, and the 1.5 standard deviation is going to be around like 295. Now that's giving you, again, that's about $6. That's about $6 worth of room, yep. Another $6 of runway. And now you're at a 1.5 standard deviation, and you just improved your odds a tremendous amount. I like to trade put credit spreads at a 1.5 standard deviation out. So I'm looking potentially, like I said, I was initially on that chart because of the range established around 300. Now I'm on the option chain. I'm seeing, all right, I'm about the 90% mark is just around 295. I'm right there. I'm looking to sell vertical. And then for myself, that's about 26 credit. That's phenomenal. Mm-hmm. Bump this bad boy up to about 20 or so. And now we're talking $500. And that's pretty good. I mean, $500 for less than $10,000 put up, which is fine in my case, which is good in my case, because now we're talking, that's just under like a 0.05 credit to collateral ratio, which is kind of like I don't like to trade anything lower than 0.04. Mm-hmm. We're talking 0.05, which is great. 0.07, 0.08 is phenomenal. If we can get that 0.10 like we were showing earlier, I mean, that's great too. But I mean, again, 520, the chance to win 520 minus fees, putting up 10,000, mm-hmm. but knowing that you're at a 90% chance to win when you enter the trade on a Monday. Mm-hmm. That's good odds. You're outside of a 1.5 standard deviation move. You're outside of the expected move range, and you're outside of the candle range of last week. Those are 3 major indicators of high probability to go. High probability credit spread. Mm-hmm. So that's like the perfect credit spread in my mind. That is what I call a maze spread. Yes, you're giving yourself a lot. Like if I were to trade at an 80% chance, yes, I know that I could make $100 per spread. But why am I giving myself that much risk, especially with the VIX shooting up? Because when I trade these spreads, I just don't want the stock to. I win no matter what if the SPY does not hit 290. What is it, like 295.26?
Yep.
As long as it doesn't hit my break even, I win. So, and right now the SPY is at 326. So that's a really great runway for me to know what's going to happen during the SPY. And I know, all right, I saw last week the SPY moved -6 on Tuesday, -8 on Wednesday. Then it moved up. Anytime the SPY moves up, that's increasing your runway.
Yep.
Yes, that's going to make your spreads valuable, but I don't think about that. I think about how much runway I have from my short strike. And as soon as my runway gets to about 1 or 2, that's when I'm thinking, all right, I can either take the position off for a small loss, or I could potentially use another position to hedge this position out so I can create a break even between two positions and still gain 6% on the account on two other positions I'm taking. If I ever usually take the SPY, I'm usually going to take the IWM. I'm also going to take the DIA, and then I'll look between the QQQ and the TQQ depending on the mark of the spreads. If I'm seeing that the TQQ has a ridiculous option trade, I might go in on the TQQ, close it at 50%, knowing that's going to cover my SPY position entirely if I need to close my SPY early.
Mm-hmm.
Just certain check marks like that is really a great way to think about how to build a portfolio around the CRAD spread.
No, that's perfect, man. Like, I can definitely see this as your forte. Like, this is perfect. How did you like that? I'm just really impressed by how you were able to figure out like you said, a maze spread. Just how did I'm just really curious in how you just found like that method and
Yeah,
how
so
it's so
I
cool.
I, I will be honest. The easiest thing. I mean, I'm an engineer by trade. I'm a chemical engineer.
Hmm.
So it's just probabilities, statistics. These are all classes I was taking in school. The biggest thing that I saw is that the market has a behavior where it's kind of it can be circular in nature, but it mainly just goes about establishing zones of where there's price acceptance. And when you see price acceptance, that's when you're going to see a bid size and ask size of right around here. I mean, this market's closed right now, but if you see like 80-25, I mean, this is a massive amount of volume of contracts around the SPY. So I mean, right now the SPY easily has acceptance all the way from 319 to 335. Now the easiest way to establish acceptance as the day goes on is just to watch the price action, because you could see if the price action, if it hits a certain price and then shoots up the other way, all right, obviously there's acceptance there because people are buying and selling and creating volume in the market for it to go up.
Hmm.
That's good. I'm establishing brackets of acceptance. And what I'm looking at is I'm saying, all right, I know what happened last week. I saw it started up there. It went all the way down here. It had an acceptance range of 20, which is really big. So, all right, I'm trading a spread now. That's the vehicle I want because I want to collect money. I want to be the bank because I'm giving them 5,000 for 500 back. If you guys don't know, that's literally what your bank does with money when you put it in your own account, and you get back to 12 cents in interest, which is not necessarily a good deal, but your money is safe. The biggest thing is that
12
I'm being the
cents.
bank in this case. I am saying that there's a 90% chance that the SPY will not go down to 295 next week.
Hmm.
I'm going to take those odds. Actually, in this case, it's 90%. So 90% chance that the SPY does not hit 295. I'm willing to put my money on that. If you want to think about this at the casino, go for it. If you go into the casino having a 90% chance to win, they're going to take you out in handcuffs thinking that you're cheating the game. So this is literally the way to become a casino is to do this. But the biggest thing then becomes risk management.
Hmm.
You just want to make sure that you are in other positions to diversify if one position goes in the money. That's the biggest thing that people don't do. They go huge on these spreads. The other thing is that I usually make my spreads about 5 to 8 wide. Some people will make it 20 wide. Now, what happens when you do 20 wide? And let me just do a 313 here, for example.
Yep.
Or let's just do a 315.
No, this is great because this was another question I had too. Was
Yeah.
even though your collateral's bigger, what are you looking at as far as credit?
Right.
So
So
this
you
is
do it.
cool.
Let's just say you're trading a 315, 75% chance to win. We'll just make it 15 wide.
Yep.
You're collecting $223 per spread, and you're selling 10 of them. That is a $2,230 profit. You're putting up $12,700 for that spread.
Mm-hmm.
If you just were to get close to in the money on that, you're going to be losing about $4,000.
Wow.
That is, yes, you can make them wide as you want. You could make bank. You could laugh to the bank and when you withdraw that 2,230, but the platform is going to be laughing at you as soon as it starts to go. If the SPY starts to go down, which is SPY probably will go down next week due to the election and maybe up at some point. I honestly don't know how the elections play out. That's why I'm not really going in on it.
Yep.
This amount of money and the fact that the delta could just rise about, if the delta just rises about 10, so like from 0.10, or in this case, we're trading at 75, so about 0.75 to 0.85, you're going to be hurting. This is too much leverage into the position for too little. Because again, you're talking a 0.0, what you're talking about, it's a 0.06, which is okay. But again, this is just too much collateral. It's just too much.
Yep.
So I mean, if you make it wide, go for it. But again, we're talking the difference is about 15 on the spread. That's $15,000. And in this case, you subtract the credit you get, and you're left with 12,783. That is how much you need to enter the trade. Because even ThinkorSwim is saying there's a great chance that this spread is going to be taken out. And when I say taken out, that's a max loss situation. That is when the SPY in this case is trading below 300. Funny, if someone were to take this trade and they were in that, I know that I'm in at 295. The SPY only gets to 298. I'm winning, and this person just lost $12,000.
Yep, that's the difference.
That is the difference. That is the difference. So yes, I don't make my spreads as valuable as they can be, but I roll the probabilities in my favor, and I also am diversifying my position by taking other positions on, which yes, whenever you add a position, you're taking on risk. But the goal of a trader and the goal of any investor is capital preservation. I know that I can preserve my account and grow my account at the same time by knowing if I take a leverage position on TQQ at the same probability level, but only take it out at 50% of the 50% value, which in that case, if someone ever refers to that, basically you're going, if 100% value on the spread is $223 per spread. If you just divide that by 2, that's 50%. That's what you know to get out at.
Yep.
That's Xing at 50%. That's what people are going to tell you to do on YouTube. Other YouTubers are going to say for a credit spread. I'm going to say hold out till expiration, or at least till Friday, to try to collect as much as you can, because you're at such a high probability out of the money.
Yep.
Sometimes you take these spreads at 90%. By the end of the week, they'll be at 99% probability out of the money. You better just hold that till expiration. I don't care what happens in after hours.
Yeah.
Some people might not like that, but if that is the case, if you're at 99% probability out of the money in after hours, you need the stock to potentially drop. In this case, the SPY. You would need that. Let me just tell you, you would need it to potentially drop all the way down to 225.
Yeah, that's
which if it dropped to 225, we have much bigger problems in the market.
Yeah, exactly.
So that is why I'm saying, obviously, when you take these positions, I hold to expiration. Some people might not like that. That's just what I do. I'm confident doing it. I'm comfortable doing it. I'm doing it, not even necessarily watching it in the after hours, because I know, one, I have alerts set, and two, ThinkorSwim, if something tragic were to happen, ThinkorSwim can get me out. They have my risk parameters set. If you guys don't ever know this, you can call your broker, tell them this is when I want to be taken out of the position manually, and you can tell them that, and they can write that down in their system, and they can take you out. So that's, if something were to happen, that's there. But like I said, that is the Maz spread. The easiest way, guys, if you don't necessarily want to do the tracking, I have an Excel spreadsheet of about, what is it now? About almost 8 months of data. If you guys ever wanted to start, just start writing down this number at the beginning of the week. Write down the journal what the open and close were of last week, as well as the range. Open and close meaning where it actually closed and opened, that range compared to this range. the range of 20 minus, open and close of 342 to 26. So that's only about 18.
Mm-hmm.
So those numbers, you start writing those down in the journal, you're going to see that the markets are moving. Excuse me. They're moving they're moving in a cycle. And I really like to see, you can see that it goes down to like right here to 295. I'm trading down here and the market's up there. So that's literally what I'm doing. Some people will say, "Oh, you're trading on this support level." I'm like, well, it doesn't matter to me that there's potential support level there, because one, support's always subjective.
Mm-hmm.
Anybody could say, "Oh, the support level's there," or "Oh, it's right here because the wick touches." I mean,
Yeah.
that was the stuff that just made it so annoying in forex, about all the people who would argue that how to draw the support levels. In the end, forex could not give you these type of calculations because it's all a decentralized broker. When you're trading on the stock market, it's New York Stock Exchange, it's NASDAQ, it's that. There's a whole bunch of other exchanges. And when you trade on the options, Chicago Board of Options, it's just one thing.
Yeah.
So that's really it, guys. It's probability out of the money, and it's standard deviation trading. If you know where to set up your bracket for a 1.5 standard deviation trade, then you're gonna see a lot of success. And I think based off of what's happening in the premium as well as the free Discord channel right now for Logan, we're seeing a lot of success with spread trading. I want to give a shout out to Naz Life from the free.
Definitely.
He started following my trades, and yes, he's not necessarily trading the total credit value of what I'm trading. He knows though that if he sells the same strike that I sell, that gives him the same probability of the win, and then he adjusts the width of the spread for his account and what he's willing to risk. He's grown his account, I think, already 15 or 20%. Shout out to him. He's doing phenomenal. He's also now a mod in the chat. So he's a testament of how this can be applied to other people. And it's not necessarily something that it's something that anybody can do. You can always trade these spreads. There's so many videos bashing spreads, but man, once you find a system like this, it's hard to beat.
I was gonna say, yeah, it's like even for me in my portfolio size, and I have a ton of buying power freed up. I'm just very excited to continue to, because like following your trades, I haven't taken a loss yet, and I know like there was one week you got stopped out of a position, and I just happened to follow like 3 out of the 5, and you won 4 out of the 5 positions, and I just
Right.
happened to be in like the 3 that won. So yeah, I'm another one that's like, once I saw the power of this and kind of this method, that's where I got really excited and was like, this is kind of what I want to start focusing on to mitigate my risk, because I do play naked calls and puts sometimes, and or a lot of the time, honestly, but not recently, of course, just because of the volatility a little bit and have my interest in spreads. But yeah, shout out to Naz as well. And yeah, that's really, like you said, I've seen a lot of the people who follow your trades do really well on spreads. And even like my buddies who are in the premium chat, they'll send me like a Snapchat and be like, bro, I made $80 this week off your spread, off of like the Maz or Maz spreads. And I'm just really excited to see, what I can continue to do and slowly build my collateral. And it's just really cool to see.
Yeah, absolutely. I will say, yeah, it's definitely something that people are doing. I mean, I'll just say it this way: one spread a week covers your membership costs for the premium.
Yep.
It's very easy,
Very
no doubt
easy.
about it. The other thing, guys, if you are going to trade ThinkorSwim spreads, you do need the margin account, because you have to give you the buying power, and you have to unlock spreads. So basically, you are going to start with a $2,000 minimum in your account to trade the spreads. But hey, if you need to save up to that $2,000, hop on, do what you got to do. Hop on Robinhood, connect with Logan, connect with Wolf, connect with Lynn.
Yep.
They can build your account till they get to the point where you could save that money to put in the ThinkorSwim account to start trading those spreads with security, knowing that you can enter and exit when you need to, and potentially urgently if there's a flash crash or something like that. So yeah, that's really it.
No, that's perfect. And the other, yeah, that was kind of the other question that I have, and it's not even like as much related as like market stuff or statistics, but it's just like I wanted to ask because I've had a lot of the premium members, but also other free members too. What they asked me the practicality of starting with $2 to $3 to $4 to even $5,000 to trade spreads with, and they said even if they take 1 to 2 positions a week, like hey, I just want to make $30 and put up 400 for collateral, and I'm cool with that for my spreads for the week, and then I'll trade for the rest of the money they want to make that week. And I
Right.
want to see like your perspective on the practicality, but also like as far as learning and everything like that for people who have smaller accounts and haven't wanted to risk their money in trading options as much because of the volatility just going crazy. Maybe they get stopped out really quickly. So I just want to see your perspective on like the practicality of, hey, I'm only going to do spreads. I have $2,000 in my account and I want to dedicate that whole 2 grand to spreads.
Right. Yeah, that practicality, it's obviously extremely practical. What you're gonna want to do is either stick to one ETF that you really just focus on that behavior,
Mm-hmm.
or instead of trading at a 1.5 standard deviation, you could trade at a 2 standard deviation, which is going to be, I mean, any statistic major would show, let's say that's 99% probability out of the money. In our case, bump it down to like a 1.75 standard deviation, go like 95% probably out of the money.
Mm-hmm.
If you were to do that on the TQQ, um, again, we'll just show this real quick, and we'll minimize their collateral. So right now, like a 72 to a 71. Let's keep it. Now, the nice thing about this is these are single options. You can see that's a $100 difference between the strikes. So if we do like a 72 and like a 69, that's so that's about $300 collateral collecting $10,
Mm-hmm.
and that's that'll add up to cover there would be a membership cost or whatnot.
Yeah.
As soon as you have more money in the account, let's say you're starting with a $3,000 account, well, you should be able to get $2,900 starting with a $3,000 account. You get $100 weekly. That's pretty practical to me. I mean, after
Definitely.
fees, $87, not
Yeah.
bad.
And playing the 95% probability chance
95% chance to win going in.
to make 100.
Um,
Yeah,
and
that's
obviously the TQQ, this is the biggest number you guys have seen yet, plus or minus 18. This thing, so when you follow the NASDAQ index, when you follow that, if that starts to go down, this thing is going to move 3 times with the volatility of the actual index. But that's why you're seeing so much value down here,
mm-hmm.
because it just has so much. The marks are so filled. I just like there's just so much money available on this thing. So yes, this is a monster. The TQQ is an absolute beast. Just have to make sure that you're using your risk management strategy. My risk management strategy is based off of deltas, because I know that I think not where the TQQ goes, but based off of what happens with the deltas. Because with the risk management, I said it that I exit the spread when the spread value increases by 15 or 20% based off of just whatever's happening. Sometimes I make it even 10%. So it doesn't necessarily mean because this spread will potentially, if it's Wednesday and this spread goes up 15%, the TQQ is probably priced in around $84. But your short is still at 72. So you're at an unrealized loss, but your position is still profitable. So it's a psychology battle too when you take these spreads, because you're going to say, all right, well, I'm seeing a lot of red, but this TQQ's at 85 and my position's at 72. That is a ton of room still, and you're on a Wednesday. Then you have a Thursday and Friday still to go, and Friday after hours. The biggest thing is these spreads expire worthless at 5:30 p.m. on Friday.
Yep.
So that's a big thing, guys. 5:30 p.m. is the deadline for assignment. If people for the other, when you sell these spreads, someone has your opposite side. So when I'm selling a put credit spread, that means someone has a put debit spread. And in reality, someone has a put debit spread on the TQQ, which is, I don't know why, but they would. It also means that someone also owns a TQQ. So someone potentially owns 1,000 shares of TQQ at 72. So, and then ThinkorSwim, they match the buyers to the sellers. So if this dude wants to execute his option and I'm in the money, it's going to happen. Dude's going to get he's going to end up getting his, I'll be assigned on my end and he'll be out of his. So there's again that 5:30 p.m. is that deadline for assignment. So you have to your position expires worthless at 5:30 p.m. One thing to note, I didn't go over this because no other examples had it. It's still earnings season. So what I do when I trade a spread during earnings season is I have this number and I add the market maker move, which is what this number is. I add the 12:30 to it. So when I do my calculations, I probably wouldn't trade the TQQ because now we're talking almost plus or minus 30.5 or something like that on the TQQ. And it's currently at 117, 118. So that's really going to put me like almost down here at like a 66, 65 just to be safe based off of this. And there is not much happening down here. In fact, there probably isn't enough size once the market comes back. Right. So make sure you include earnings into your calculations for your spreads. Trading spreads on individual stocks during earnings is a whole nother ballgame. But when you trade ETFs, when the stocks holdings in the ETFs have earnings, you're going to see this gold number up here on ThinkorSwim. This is not available on Robinhood. This is only ThinkorSwim. So you add that number to this number. And you go there. And also trading an ETF of 155% implied volatility, that is just wild. But that is just the practicality of trading at a 95% clip, able to earn about $100 a week.
Yeah, that's amazing, especially with just that small collateral. Like $100 a week is a game changer for most people, and that's what a lot of the premium members have been telling me too. They've been like, I want to make consistent income weekly, and that's kind of been my goal with the premium Discord, was for people who want to take it to the next level and not just kind of fall in and out to where they're like, yeah, I wanted to try this stock thing, but maybe it's not for me. I really want people to kind of integrate it just like you have, to where you're consistently making weekly income, and
That's
to look
right.
at your money in a weekly thing instead of like, how much can I make today? Because you open yourself up to so much risk when you're doing something like that and looking at the short term when it comes to money.
Another next level thing, guys, if you do like taking leaps or buying options, which is going long delta and opening yourself up to theta decay, notice when I sell these credit spreads, I am collecting that theta. So that that theta decay is what I want. If you buy options and you're having the theta decay against you, if you have a lot of money in your account, you can take a put credit spread at my probabilities, gain that money in credit, and then potentially put up some of that credit to then take a long call outside of the put credit spread to collect any money that goes to the upside. Because that's the one downside to changing the put credit spreads. If the stock were to shoot up really far away, you're only going to gain the credit between the two options that you've sold. So if you do put money up for a long call outside of your put credit spread, potentially at the money at the money call, and then have your put credit spread below and jack up the number of contracts, that is going to be called a Jade lizard, actually a reverse Jade lizard. And that is a really great way to gain extra exposure to the upside with the put credit spread. Then on Thursday, add your call credit spread, cap out your call credit spread, and then continue to have your other long option running. Take the long option with a 12 days expiration, so have it go into next week. That's going to be a really great way to also build your account if you ever were to take a large loss on a credit spread. So there's a lot of once you know how to trade a credit spread, you're going to understand how the other option strategies work. So I recommend starting with a credit spread. It's the safest. It's safe. And when you use my probabilities, it can become extremely dangerous if you trade really tight. But once you understand credit spreads, you're going to understand deltas, you're going to understand thetas. Then you can start to look at how buying long options is a net losing strategy, but can be used to hedge against the limited profitability of a credit spread.
Mm-hmm.
So there's a lot. Once you start credit spreads, you're going to open yourself up to a whole new world of option trading. It's going to be really lucrative, hopefully for you. But also make sure to come check out Amplified Investing. I mean, we really are focusing on helping people learn all aspects of this, especially the risk management of credit spreads, which a lot of people say, oh, there's no way to manage the risk of credit spreads. Well, I disagree.
Yep, me too. Yeah, I disagree as well. And then my very, very last question, and it's going to be a shorter one, but I was going to just ask, how come you choose call credit spreads on Thursdays?
Yeah, so when I trade call credit spreads on Thursdays, what's happening there is I'm already in, like, say, a put credit spread.
Mm-hmm.
I'm in a put credit spread. The stock is moving up, it's moving down. The first thing, whenever, I guess the biggest thing here is when you enter the call, well, you see the plus or minus numbers, right?
Mm-hmm.
So this is saying that that I put the put credit spread below the 18.6 level. That number is going to change throughout the week. So when you get to Thursday, that plus or minus 18 could be plus or minus 6. So when you make an iron condor in the beginning of the week, you're opening yourself up to not knowing. You might know how much risk to the downside, but you have no idea what your risk to the upside is going to be.
Mm-hmm.
Because the 18 could increase to 20. It could a whole bunch of different scenarios can occur. So an iron condor and on Monday, yes, will collect more credit than the way I do it, but I'm doing it in a safe manner. But the biggest thing about the iron condor, though, is that on the call credit side, I have no buying power. My buying power is 0,
Mm-hmm.
meaning it does not incur any deductions. It basically just adds more risk to the total portfolio, but it's only for a short amount of time. So when I trade call credit spreads, it's literally the same thing, guys. I report the price that I subtract the 18 and the 12 from, in this case. So I would write down on Monday morning 117.45. That is the open price. I write that down. I then compare what's bigger, the plus or minus 18.61 plus 12.3, or in this case, let me just show you the chart on the TQQ. The thing was a absolute monster with a range of 26. So the plus or minus 12 and the plus or minus 18 is greater. So I'll use 30 in this case. So I'll go back to my tab. Monday through Thursday, I'm on the put side. I'm looking potentially around, that's going to be just about 87, 88. So that's where I'm at. And that's about 86, 87%. If you want to be ultra conservative, you can even take the TQQ and the QQQs. It also works. You can take those at the 95% and still make money.
Mm-hmm.
So I'm positioned at 80, 86, 85. That would be where my initial position is. That's Monday through Thursday. On Wednesday night, I record how much the stock has moved up or down. And then I'm at my 117. I go back to that initial 117 number. I look at what the expected move is for the rest of the week. And I looked at what the entire range has been compared to my entire expected move.
Okay.
So if the entire expected move is greater than the expected move, the remaining expected move, then I know there's still more room to the stock to the upside. So I just trade that then at a higher clip. So this looks like there's a ton of options. When you get to like Thursday, there's not going to be a ton of options here. Yeah. They're going to be a lot less. So a call credit spread usually has about $8 to $10 runway on a Thursday. Mm-hmm. So I am saying that I believe that the stock will not go $10 higher, because this number over here on Thursday morning is only plus or minus 6. Okay. But I'm still trading outside of that range. Okay. So it's basically just doing what I'm doing on the put side to the opposite side in a shorter time frame. I open the put spreads. The put spreads are Monday through Friday. Call spreads, because the call spreads, they add extra money to the portfolio with no buying power reduction, but added risk because they still have the collateral, mm-hmm. but the collateral is covered in the put credit spread.
That's
So
amazing.
essentially, no extra buying power. I create a dynamic iron condor, sometimes skewed to the downside, sometimes skewed to the upside. That just depends on what happens with the stock. And I base the decision of where to put my strikes off of the initial open on Monday at 117. So if the 17, no matter where it's at, it could be at, if this was at 100, I'm still making sure that I'm trading the 117 plus whatever it's currently at. So I always want to make sure I identify that range. And sometimes you can know, sometimes the call credit spreads, you can't take them because if the stock fell a really far amount, and I
Mhm.
know, all right, I'm still open to that top range. It's not going to be able to be taken. That's okay. I stay in the put credit spread and I'm good to go. So just a lot of psychology. Usually I take a call credit spread if the put credit spreads on average are about 60% profit on a Thursday morning. That's a really
Okay.
good way to say good way to gauge. If you guys don't want to do the technicals, that's a really good way to gauge that the put credit that you could take the calls. If your put credit spread is losing, don't take the calls because
Right.
then you're just going to put yourself too tight because your option chain becomes constricted. You'll see you'll see a lot of zeros. See right now the zeros are already at 190. I could probably tell you next week the zeros will all the way be at like 138. And then these zeros continue to add on as the week goes. And the zeros are just because no one is willing to sell at that price.
Hmm.
So yeah, the call credit spreads a dynamic iron condor, sometimes skewed to the downside, sometimes skewed to the upside. What I call an entire position is a put credit spread and a call spread. A half position is either just a put spread. I never take a call credit spread on a Monday. I create again that bell curve. I create that cycle where I start with the stock going down and then I'll cap it at the top. But again, I never change my probability. I always want my probabilities to be where they're at, but I want to make sure that I'm still within the bracket
Hmm.
at the beginning of the week. If I'm trading inside of that bracket, then the probability that's showing up is not actually what that probability is because there's a probability skew as the week goes on.
Hmm.
So just stick to your guns, do the math, set the bracket up, and maybe the best way to do that, again, we can eventually start doing maybe some live streams on Monday morning or something like that to
In
show
the
you guys how I establish those brackets, what numbers I'm writing down,
in the
all
premium,
that.
yeah, that'd be cool.
So yeah, so maybe we can get into that. But yeah, so it's all about this is a way of bracket trading and then a credit spread underneath the bracket. So
No, I love it, and I'm pretty sure you answered all the questions. Have you said everything you pretty much wanted to?
yeah, I think we captured it. Like I said, guys, make sure you give Logan's channel, like this video, comment if you got any questions. Make sure you hit that subscribe button. Come join Logan and myself, Wolf, and Lynn. I'm sure she'll be back.
Yeah.
Come join us in the premium if you haven't. If not, the free chat is always there. We're
Yep.
active in there too. I usually give all my call outs in the premium, and I give one call out a week in the free. So yeah, this week again, I'm on cash. This next week, I'll probably be after November 6th. I'll probably be trading again. So feel free to come join me. And I'm really looking forward to getting to know more people in the community, and let's start to make a Feta Gang army, man. Let's do
Yep,
it.
let's do it, man. Yeah, definitely. That I love making money off contracts that expire. It's so satisfying.
It sure
Just
is.
it really like you really feel like the bank. You just wake up and you're like, "Oh, okay, there's more interest that's owed to me today." Like it's so cool.
Yeah, I can tell you guys, 10% growth on your account is a lot better than the 0.002 interest rate that you're getting on your savings in your bank, unless you have some money market account that's like getting you 8% or something like that, which I know theirs are out there.
Yeah.
But yeah, I mean, really, this is you becoming the bank. You are choosing the right mindset of knowing that a stock is not going to trade at the price that you are selling. That is all you have to worry about. If your deltas then start to rise, that's advanced stuff. And then we can go over that, tell you guys how to exit. Biggest thing though, if you're going to trade singular credit spreads, 90% probability out of the money or greater,
Hmm.
go with that for benchmark. And if you're going to add multiple into your account, potentially enter less contracts on one position or just enough to make sure that it could potentially cover the loss on another spread if you think volatility is going to rise. So in my case, my SPY spreads are usually covered. buy the TQQ,
Mm-hmm.
and I would close the TQQ at 50% to cover the SPY. Just simple stuff like that. That's all advanced, but hey, that's stuff that we cover in the premium. So
Definitely.
yeah, premium's a great value, guys. Definitely check us out. Other than that, I think that essentially is a wrap.
Yeah.
Um, this is the Maze spread. If you guys got any questions, just hit Logan up. Yeah,
Yeah.
this was a great talking to you, Logan. I appreciate the opportunity, and I hope you have a great rest of your day. And everyone out there on YouTube watching, I hope you guys can pull off a successful credit spread to start. And make sure to join that Discord down in the description.
Heck yeah. No, I appreciate you being on too and going over the strategy. We spent about an hour and a half talking about it, which is so well worth it. Can't even explain it, how well worth it this is going to be for everybody. But I really appreciate all your help in the Discord and all your help on YouTube right now. And if you guys have any questions, make sure to leave them down in the comments or even just a thank you. And hit up the free Discord and then you can join the premium one. There's a spot for you to type in if you're interested in joining, and then I'll DM you. Maybe Maze will DM you, and I just think it's really cool to see the community grow between the free one and the premium. I just think it's really cool, and just to help everybody one on one. So I'm just really happy that you were able to make it today and that we could put this video together.
Yeah, I really appreciate it, Logan. Yep, next thing we can continue to do these videos too, guys. Let's do this. Anybody who subscribes to Logan's channel, likes the video, and comments, we'll do a sweepstakes for a one-on-one with myself to go over any questions you have on the spreads. So let's do that.
I'm about that. That'd be cool.
All
Let's do
right.
it.
Thanks so much, Logan. Have a great rest of your day, guys, and safe trading.
Yeah, see you later, Maz.
See ya.